Did you know that banks can legally seize all your money whenever a major financial crisis erupts? And do you know where financial markets are headed right now? If you're a regular on our channel, you've probably guessed it. We're on the brink of a historic financial meltdown, and the odds of a widespread banking collapse are getting increasingly higher. The United States banking system is a mile-high house of cards. Every day it passes by, it looks wobblier and more susceptible to crashing down all around us. With the central bank intervening in private banking institutions and soaring interest rates leading businesses to default on their loans, a very scary scenario is forming. And if I were you, I would take my money off the system right now. In today's video, we expose why U.S. banks are about to fail catastrophically and the risks we're all facing, but no one is telling us. Before moving on, we kindly ask you to support our work with a thumbs up and don't forget to subscribe. U.S. banking institutions have been silently decaying for decades. Our money isn't as safe as we would like to believe. Our system is flooded with banks. We have state banks, banks that operate internationally like TD Bank Group, Bank of America, Bank of New York, Fifth Third Bank, and also institutions that provide investment banking services and investment management services, such as JP Morgan Chase, Goldman Sachs, and the bank holding PNC Financial Services Group, along with asset management, national banks, and other institutions offering private banking services and public banking services. For the longest time, the idea that U.S. banks were the benchmark for how powerful a bank could be became almost unquestionable in our society. But that belief is probably linked to the narrative that the United States itself is the most powerful nation in the world. We must face the truth. Our country has been losing its power on the global economic stage, and that deterioration extends into our banking sector as well. Understanding the principles of banking isn't an easy thing to do. We don't really see banks as businesses, but that's exactly what they are. And just as any other business out there, they have the potential to fail too. Obviously, no nation in the world wants its society to think that its banks are prone to failure. That's why they spread the notion that our banks are entities that aren't fallible. But when we look at the data, several indicators tell us otherwise. For example, over the past 5 years, despite one exception, not one single U.S. bank has made it to the safest offshore banks list. A major contributor to that is the fact that we have nationalized our banking industry, and now the central bank controls the flow and supply of capital of private institutions. After the 2008 fiasco that prompted banks doomed too big to fail to collapse, the government realized that a single bank failure could trigger a devastating financial crisis due to the interconnectivity of the market. At that time, central bankers stepped in as lenders of last resort. Profligate private sector loans were moved onto the public sector balance sheet, and vast money printing gave our economy room to heal. Then, the federal government created a policy of protecting the banks. Although you may be thinking that because the government is protecting the banks, your money is secure, that's not actually the case. In the last financial crisis, 4 out of 10 U.S. banks failed or received government assistance. But no one cared about the people. Everyone just wanted to make sure that these big companies did not have to shut down. If our government has to ensure that something is operating right by providing extra support, that means something is really wrong in the first place. Up until this day, measures taken by the Fed and government regulations continue to raise red flags. A recent example is the record money printing that added trillions of extra dollars to our money supply and unleashed the worst inflation crisis in 41 years. In the past, Whenever a bank created too much currency out of nothing, people would eventually notice and a bank run would materialize. But when a central bank authorizes all banks to do the same thing, that becomes less likely because it makes an occasional and local problem systemic by housing it in a national institution. An analysis released by financial experts with The Telegraph notes that the creation of the Federal Reserve was originally justified as an introduction of a device that ensured economic stability. But the occasional chastisement of imprudent bankers and their foolish customers was just an excuse to get government into the banking business, they wrote. By making private banking problems systemic, the Fed can solve them using its favorite method, printing more and more money. It's loosely analogous to the way the government handles the problem of forest fires, the experts continued. Extinguishing them quickly provides an immediate and visible benefit, but the delayed and forgotten consequence of doing so is that it allows decades of dead wood to accumulate. Now, when a fire starts, it can be a once-in-a-century conflagration. In other words, the Fed's actions do not solve the root cause of the issue. It just places a band-aid on an infected wound. For that reason, today, we have what experts call an unsound banking system, which puts our savings in great danger. Before the creation of the Fed, we had sound banking, meaning that bankers would keep a 100% reserve against demand deposits. They held 1 ounce of gold in their vault for every 1 ounce banknote they issued, and they could only lend the proceeds of time deposits, not demand deposits. Right now, banknotes issued by such institutions are no longer redeemable in a commodity such as gold. The banknotes have to be legal tender or strictly paper money that can be created by fiat. So, we actually have nothing but legislation actually supporting the banking sector. That is to say, protection against runs on banks isn't provided by sound practices, but by laws. In 1934, to restore confidence in commercial banks, the U.S. government instituted the Federal Deposit Insurance Corporation, FDIC. Now, currently almost all big U.S. banks are FDIC insured. That means up to $250,000 per depositor is insured. In the case that something happens to your money in an FDIC-insured bank, you are all right till you exceed that amount. The problem is, FDIC insurance covers about $9.3 trillion of deposits, but the institution has assets of only $116 billion. That's about 1 cent on the dollar. And the fact that the Fed has controlled capital flow shows that there's little money left. So what happens when one of the biggest banks in the U.S. goes down? In theory, you would be entitled to up to $250,000. However, there's no way to make up for any money you've lost on top of that amount. And the promise that the central bank will cover up potential money losses you may suffer in a private banking institution looks sketchy at best. In a new article, financial analyst Doug Casey argues that if that actually happens, the Fed won't be able to insure all of these deposits. It would likely have to create more artificial currency to make up for the losses. I'll be surprised if the FDIC doesn't go bust and need to be recapitalized by the government. That money, many billions, will likely be created out of thin air by selling Treasury debt to the Fed, he highlighted. On top of that, the government has been using banks as a lending tool. Over the years, it has enforced and promoted U.S. banks to give out loans to help businesses. But now that the country is moving towards a deep and protracted recession, many of those loans are either going bad or will go bad soon, adding more pressure on United States banks. When borrowers cannot return loans to the banks, these institutions no longer have the same coverage as they once did. In case of a surge in the number of borrowers defaulting on bank loans continues to increase, banks will have a huge problem on their hands. However, at the end of the day, the average American would be the one paying for these souring loans. This may come as a surprise for many people out there, but you won't actually own the money in your bank account. Once you deposit money at the bank, it's no longer your property. It's the bank's. What you own is a promise from the bank to repay you. It's an unsecured liability. Technically, you're a creditor of the bank, and that means a bank bail-in would probably wipe you out. A bail-in is when a bank recapitalizes itself by tapping its creditors. That includes all of its average Joe depositors. As the current economic downturn accelerates, millions of Americans are about to find this out the hard way. Just a couple of weeks ago, the chief marketing analyst at ITM Trading, Lynette Zhang, came forward to warn the public that banks can legally confiscate their clients' money in the event it needs to stay afloat. And most retail investors are not aware of this. What's even more chilling is that behind the scenes, they know a collapse is coming and they're already preparing for a major crisis, all while promising the public that everything is under control. According to the New York Times, big banks are setting aside billions as they brace for a downturn. Since 2008, banks have kept more cash on hand to defend themselves against the crisis. However, in December, the Financial Stability Board estimated that the average exposure to leveraged loans and collateralized loan obligations, or CLOs, for the 30 safest U.S. banks was around 60% of capital on hand. CLOs account for more than 100% of the capital of small banks. If the leveraged loan market collapses, their liabilities may swiftly exceed their assets. Simply put, they will seize your money to rebuild their assets and prevent the institution from collapsing. With so many businesses struggling, the U.S. banking system can become insolvent very rapidly. Policymakers know how bad the problem is. That's why they urgently passed new bail-in rules last year. Such legislation is already codified in the Dodd-Frank Act, Zhang revealed. The executive, who has decades of experience in the financial sector and worked as an investment banker at Larsen Lehman American Express, said that these bail-ins could be part of a bigger systemic monetary reset. She explained that bail-ins allow banks to convert debt into equity to increase their capital requirements, and the Dodd-Frank Act replaces bailouts with bail-ins, in which depositors' funds can be used to rescue a failing bank. In the incoming financial crisis, practically every bank is going to be bailed in, Zhang forecasts. They've printed so much money, and yet we're having problems with liquidity in all of the markets, but particularly the U.S. Treasury market, which underpins global markets. She added that, based on recent meetings, the Federal Deposit Insurance Corporation, FDIC, is aware that there could be a major issue in the U.S. financial system and is openly discussing the likelihood of implementing bail-ins. There are discussions and deliberations over whether making retail bankers explicitly aware of the legal bail-in stipulations would create panic and exacerbate the potential problem. They're laughing at us, she said. They're saying that normal retail clients don't need to understand that there's really no money in the FDIC Deposit Insurance Fund. Moreover, Zhang outlines that after the wipeout occurs, central banks are likely to impose central bank digital currencies, or CBDCs, programmable forms of fiat money which allow central banks to track, to trace, and even to freeze a person's funds. This, along with de-dollarization and the digitization of hard assets, will be part of the Great Reset, Zhang warns. The World Economic Forum says, "You will have nothing and be happy," she added. Well, you may have nothing, but I'm pretty sure you won't be happy, because wealth never disappears. It merely shifts location. So if you don't own it, somebody else owns it. And as we all know, then you're renting everything. The ugly truth no one wants you to see is that the central bank has lost control, and at the same time, the U.S. economy is grinding to a halt. It's only a matter of time before stock markets collapse under the weight of their lofty expectations and record valuations. And you can be sure that your bank will collapse at the sight of a financial crisis, and the system will not be able to cover any catastrophic fall of any United States bank. Whenever you hear a central banker or a politician say something won't happen, you can almost be certain it will happen, and probably soon. It's like the old saying, believe nothing until it has been officially denied. Most people have no idea what really happens when the banking system collapses, let alone how to prepare. But as we get closer to a widespread banking collapse, choosing where to put your money is crucial to ensure it doesn't get caught in the crosshairs. A better option for you would be to close your U.S. bank account and look elsewhere. The clock is ticking, the stakes are too high, and if you don't act fast, you risk losing everything. Thank you for watching.